Afternoon, folks. It's Dave Burrows, Chief Strategist at Barometer Capital Management. I want to thank everybody for taking the time to log in today. We've been doing these calls now since the beginning of COVID, and our locations have shifted a couple of times. I'm working from the Barometer North office in Midtown Toronto, and I have Fred Pye with me on the line today, who is the CEO of 3IQ, and we're going to talk a little bit about market strategy today. We're going to talk a little bit about some of the key themes in this market. And then we're going to talk a little bit about Bitcoin and cryptocurrency and how that may play into the world that we are in currently as a piece of the portfolio. Just as I always do, I want to start by saying, look, everybody has an approach. Everybody has a target as to what they're trying to do and the strategies that they run. Our strategy is meant to be a very flexible strategy and ultimately do three basic things. Because the world is constantly changing, we need to have a process to identify what's relevant and focus our client assets in those areas. And we call that market leadership. And that could be specific sectors or themes or asset classes that for whatever reason have a tailwind, some structural advantage, and it's attracting capital. And so ultimately we're trying to own the things that other people want to own or are going to want to own, where things, the assets can be revalued, multiples could expand, or spreads could compress, and own them throughout the period of revaluation. We're of course always looking for change, new leadership to emerge, old leadership to start to lose its steam, and be prepared to rotate the portfolio as need be. Sometimes that happens quickly, sometimes it is a more slow process. And then of course there are those times when nothing's working and where everything is highly correlated and where the best thing that you could possibly do is sit on your hands with some cash in your pocket. This is probably not one of those times, but there are times to play defense and you have to be willing to do it. You have to have some process to take you out of positions that either have stopped working or are not working and live to fight another day. So our process is a very tactical approach. We are very focused on finding those structural themes. We are not going to be everywhere. We're really going to pick our spots. We believe we entered a structural bull market in 2013 in the US stock market when we exceeded the highs from 2000 after 13 years of the market going sideways. And at that point, the market was unloved. Certainly, there was lots of people who had been through the difficult declines of 2008-9, certainly the decline in 2001 and 2 and the tech wreck. Who were very skeptical. And even today, here we are, 7 years later, and people are still pretty skeptical. But when these bull markets start, like the 80s and 90s or the 50s and 60s, they go on for a long time with interruptions. You still have to navigate some pretty big drawdowns. But ultimately, we think that we're in a structural bull market in US stocks and have been for some time. And that just continues. The S&P has been in a channel since 2013 with some interruptions, the NASDAQ as well. These have been key areas of market leadership and US stocks have been our focus for several years. We also, over the last couple of years, have talked about the fact that we think we're going through a bottoming process in long-term interest rates, like we did in the early 1950s after the Second World War. And when that takes place, it does take some time, but ultimately what works in falling interest rates may be quite different than what works in rising interest rates or a reflating economy. And so we have to keep that in mind. Most of us have lived all of our investing lives during falling interest rates. And that has built some predilections in what we like to own and what we have had success in, but it may not be those things going forward. Certainly, we talk about being cautious with bonds. They came to be known as sort of the safe investment. Since 2000, actually, bonds have had the same return as stocks until a year ago. And we know that we hit exceedingly low bond yields or high bond prices in the beginning of the pandemic. That may have been a generational low, about 50 basis points on a 10-year bond. And since then, bond prices have been steadily weakening. So I've always had people say, well, I'm happy if I hold my bonds to maturity, I'm going to get my coupon one way or the other. Well, you can get your coupon, but if your bond prices are falling or inflation on the other side starts to rise in excess of your coupon, you're not going to be very happy. And so this is something that we think is picking up some steam. And there's a mountain of investors who are along the bond market, who one by one may feel a bit of pain, they're not making a return, start to rotate their assets. And we think that that is supportive of other types of assets, like, for instance, global equities. We know commodities have been in a bear market for 10 years and they go there in their own long cycles. We've talked about how it looks as though many areas of the commodity market are starting to make a turn. And so certainly there's lots of different areas to look at. Our top-down process is all about trying to find parts of the investable universe that we could focus in that are seeing net inflows of capital. Where is money getting put to work now? Where is it coming from? Where is it going to? We want to focus in those areas of market leadership. And then we want to use our bottom-up process to try and find securities within those universes where the fundamental characteristics support revaluation and prices that support the fact that it's happening now. So timely securities with fundamental characteristics that can support revaluation. If we can do those three things, we address the three big things that impact return. We got to be in the right asset classes. We got to find sectors within those groups that have a tailwind, a structural advantage. And then we want to find securities that we can express our view with. And then the last piece is we make lots of mistakes. At the end of the day, your success is driven by your ability to recognize when you're wrong. And so the selling strategy for us, which is using stop losses, is a process that takes us out of those little mistakes without them turning into big mistakes. Okay, so let's talk big factors. We've talked now for several months about the significant stimulus and liquidity that's been pushed into the system. This is the amount of US currency currently in the system. And you can see this great tipping higher over the past year. We've talked about the central bank stimulus that has come from around the world to try and offset the dampening impact of this coronavirus. We talked a couple of weeks ago about how we are just seeing this massive week over week growth in money supply, and that what that means for investors as to what it might be that participates. So the net of it is, at the end of the day, we need to find areas of the market that are leading. One of the areas we've talked about for some time now is emerging markets, right? And technology. So let's start with the US stock market. Technology as a sector has led the market all the way through this period. Of course, there are so many disruptive technologies, so many structural changes taking place. So for instance, cloud-based computing, the companies in this area, we've seen the reports over the past week from companies like Amazon and Google. They continue to grow very rapidly, continue to make relative strength new highs. Other areas in the US market that continue to lead. Consumer discretionary has been a key group. Consumers do seem to be relatively liquid. Certain areas are benefiting more than others. The whole auto sector through disruption, electric vehicle, alternative energy is one that is going through a major shift. Even companies like General Motors and Ford leading the way. We have online retail, which continues to perform well, making relative strength new highs again today. Communication services and social media. The companies that we all know are in this space continue to grow, continue to make relative strength new highs. And also realistically in the consumer space is this whole move around cannabis and marijuana, which again, this week is having another great week. So these are all key areas around the consumer. We also know that there has been strength in robotics and automation. So this is a group that we've been focused in the industrials. We also know that fintech has been very strong. So this is fintech, this is robotics, both of them making relative strength new highs this week. So industrials, financials, certainly the investment banks and investment managers continue to lead. And then in energy, alternative energy, certainly solar and some of the areas around fuel cells have been doing particularly well, continuing to make relative strength new highs. So these groups have all been in play for some time. And just to put a point on it, in a reflationary environment, things that are more economically sensitive are probably outperforming the things that are more defensive. So we've talked about how consumer discretionary has been outperforming staples on a relative basis, technology versus consumer staples, communications versus consumer staples, or versus utilities or telcos. So we want to be targeting areas that benefit from this liquidity. Certainly one other area that's been benefiting is large cap versus small cap. So really since the middle of last year, large cap has been underperforming small cap. So small and mid cap, and we've all read some of the stories around what's going on with Reddit and some of the social media network effect, but certainly small and mid cap stocks are continuing to outperform. When it comes to income, rising rates are not good for things that act like bonds. So the bond proxies, as we've talked about, have been underperforming for some time. These are favorites of income investors, utilities, telcos, REITs. We've talked about the fact that when rates start to rise, a rising dividend stream is important. So this is a very simple ETF. It focuses in companies that have had a long history of consistently raising their dividend. We've talked about the fact that in the 1950s and 60s, as rates started to move higher, dividend growth became a leading strategy. So this is the dividend growth ETF. You can see comfortably exceeding the highs from February last year. You compare that to high dividend paying stocks, still comfortably below the highs from last year and no relative strength whatsoever. So very important for income investors in our income strategy. We've been focusing in dividend growth. Now, US dollar continues to be a big driver. US dollar has been backing off since the middle of summer. We've come up a couple times and tested this trend line. We're there again now. So it's possible we trade up and through. The longer term trend continues to be pretty solidly lower. We think it's more likely, if we take the long-term picture, that after testing this trend line, we likely go lower. And that would support what's been happening in the rest of the world. You know, we know there has just been tremendous currency printing going on. And when US dollar weakens, sometimes it's a sign that investors have more confidence. They're taking US dollars, which they hold as a safe haven, sell the dollars and buy risk assets. So we've talked about emerging markets, relative strength, new high today. Certain areas within emerging markets, this is the emerging markets ETF PIE, having just broken out of a multi-year sideways range. So that's early in a new bull market, driven by things like the Chinese consumer, Chinese internet companies. Certainly India has been very strong. When we look at the developed markets, countries like Taiwan and Japan coming out of very long consolidation ranges, and they look to continue. Commodities, another asset that tends to do well with a weak US dollar. After many years of underperforming, this is an equally weighted basket of global commodities. Coming off the lows in April, working its way higher, we consolidated recently and have broken out to the upside. Now, this isn't going to go straight higher, but certainly it's an area that benefits from a weak dollar. This is the point and figure chart on that same equally weighted. We want to see higher highs, higher lows, higher highs, higher lows. That's an uptrend. It's in place until it's not. Been a key focus in our macro strategy. So both commodities and emerging markets highly correlated. It would support the fact that the Canadian dollar has been as strong as it has been, the Australian dollar as strong as it has been. This is very early stages in a new secular trend. We've talked about precious metals and how they have been going through a major shift, and they've been consolidating over the last few weeks. This week, silver had a very short squeeze, but the picture looks higher for the commodities. But that leads us to cryptocurrencies. And crypto has obviously been a very interesting area. It's not an area that a lot of our clients understand. This is the price chart for Bitcoin in US dollars, going back over the last year, a big run up, and certainly pulled back and consolidated, tipping higher again. If we take a longer term picture, going back to 2013, what a ride this has been, from $2 to $37,000. But we know every time it's had a big run up, it's consolidated, run up, consolidated, run up, consolidated. And actually, this fall, we only just broke out again, or actually just about 2 months ago. So this is an area we've been watching closely. When it started to come out of this consolidation midway through last year, we got involved for the first time. Now, it's very difficult for most private investors in traditional accounts to participate. So in the last year, we finally have seen the advent of a couple of Bitcoin ETFs that trade on exchanges. So today I have Fred Pye with us on the phone or on the line. Fred is CEO of 3IQ. I've known Fred a long time. He has been a career star in the investment management business. And I've known him for many, many years. I followed his toils in trying to build a platform to make investing or participating in cryptocurrencies more accessible. And so because a lot of our clients really don't understand this very well, I thought it would be worthwhile to bring him on the line today. And so I want to welcome Fred, and maybe we could have a little chat about this. Fred, maybe you could tell us a little bit about your journey.
Thank you, David, for having me. And I do expect to spend some good fun time today telling you a bit about our journey. But as David mentioned, we've known each other for a long time. And in the interest of full due diligence, I am a client of Barometer. I'm a big fan of what they do. I've had a man crush on David for easily a decade. But David has seen the trials and tribulations of what we've done. I was at a firm called Landry Investment Management. We had developed a multi-asset momentum algorithm that we were trading, but I just noticed that everything was completely correlated. And David and I always spoke the same language of looking for non-correlated assets, invest in the top things that were performing. And Bitcoin, funny enough, has been the best performing asset of any asset in all of history in a 10-year period. So I was intrigued, but it took an awful lot of work, and it took some work to be able to bring this to market. So quickly, what I'd like to do is, David, if you let me share my screen here.
Absolutely, you go right ahead. Fred, I know there were many times when you must have questioned yourself going through this process, but congratulations to get to where you are.
I would say my wife questioned me a lot more than I did, and that'll bring up my first story. Is many years ago, and the funny thing about Google knows everything about you. So it knew that I was interested in Bitcoin and I own Bitcoin, but it also knew that I was a chef, an amateur chef. So I get this email one day from Google, or the spam from Google, saying, chef knife, Japanese carved steel chef knife, beautiful chef knife, only 1 Bitcoin. And I go, that's easy. And I just click, and 2 days later, in comes this beautiful redwood box with this beautiful Japanese cooking knife. And I'm staring at it, and I'm so excited about this knife. And my wife looks at me and she goes, you didn't spend $300 on a cooking knife, did you? $300 US on a cooking knife. I said, no. I said, just 1 Bitcoin. She goes, oh, I don't get this Bitcoin thing. Well, at Christmas that we just passed, I'm carving the turkey at Christmas. And she goes, how's your $40,000 US cooking knife, you, you dumb lummox? Now she understands Bitcoin. So I'm going to try and spend a little time today, and not a lot, just jumping through things. And the easy part is I usually start, and I apologize if this is overly simplistic to a certain extent, but I always used to tell people, can you explain to me this digital currency stuff? I said, well, if you take a $100 US bill and separate the serial number from the paper, where's the $100? It's in the serial number. And if I can put that in my phone and instantaneously and securely give it to somebody else, that's a digital currency. And that's really what happened. And when people say, well, I'm not going to buy Bitcoin until I can buy coffee at Starbucks with a Bitcoin. Well, like you don't buy a cooking knife with Bitcoin, you don't buy a coffee at Starbucks with Bitcoin. You will use digital Canadian dollars. You will use digital US dollars. You will use digital yen and euros. So money will be going around the world instantaneously and for free. So when David saw me challenge this, he may not know this part of me, but I've been here before. In 1983, I was working for a company called Guardian Trust Company, and Howard Kelly said, you know what, we should list our gold, platinum, silver certificates on the Montreal Stock Exchange so investment advisors can then get access to gold, silver, and platinum, because now they can all they can do is come to the bank and buy it with cash. So we went to the Quebec Securities Commission and said, we'd like to list our gold certificates on the Montreal Exchange. And the regulators go, hang on a second, those are non-traditional custodians. It's volatile, it's speculative, and it's used for criminal purposes. And so finally, after 3 years, we convinced them that gold was important for people to put in their portfolios, and it got approved. And today, some of the biggest ETFs in the world are gold ETFs. So we started on this journey back in 2014. And it took us 4.5 years and over $5 million and a real grind. And finally, we got approved. We went to court last summer. We got approved in October. We tried to build a syndicate in January. And now we've got a prospectus. It's approved. It's ready to go. We go, what could possibly go wrong? Well, apparently the global pandemic was a checkbox we didn't check off in our risk categories. And we launched to very little fanfare at a $15 million Bitcoin fund. Having said that, today we just crossed over 1.4 billion, and in 9 months is the single fastest growing organic investment fund in Canada in history. So we're very excited about that. I'm going to take a quick step back and talk to you. The way I explain people to is I explain to them about the internet. Everybody thinks the biggest single largest technological investment of our lifetime is the internet. Well, the internet, it's true. It was started in 1971 with the TCP/IP transmission control internet protocol, and that was designed by the US Defense Department to let two computers speak together. But it wasn't until 1982 till people got the SMTP, the email, which was a simple mail transfer protocol. And then 1989, the World Wide Web was born, and the information superhighway with HTTP and HTTPS, where you could now, oops, sorry about that, having a glitch. Okay, it wasn't until you could jump from one website to the next, and then came the big granddaddy, voice over internet protocol, where you could actually speak from one person to another. It just wiped out long distance phone calling. Then was text messaging, which is basically wiped out email with every kid on their phone, text messaging every day. But then in 2001, the BitTorrent protocol was created, and that was the precursor to live streaming, Netflix, everything. The way people absorb communications today is very different than it used to be. So if you follow what's going on here, the internet is nothing more than a series of computer protocols that use an unsecured network called the internet. And it wasn't until 2008 the Secure Value Transfer Protocol was invented and created that allowed you to now transfer ownership, value, title, and money over the internet instantaneously, securely, and virtually for free. And that is also known as the Bitcoin blockchain. Bitcoin is a value transfer protocol for the internet. So yes, it may have taken you 15 years to get your Netflix account. It may have taken you 15 years to get your first email account. Yes, it could have taken you 15 years before you stopped paying long distance phone bills. You will start using the blockchain to transfer ownership, value, title, or money. So let's see, what is it worth? Well, if you take a look at the internet, The internet facilitates unsecured free movement of information. And it sits on what we call a free protocol layer, which is the TCP/IP. So who made money on the internet? Google, Uber, Amazon, all the big internet companies all made money on using a free protocol. Well, when we take a look at the blockchain ensures secure movement of value, ownership, title, or money. So what is worth more, unsecured movement of information or secure movement of ownership, value, title, or money? Meaning every real estate transaction, every medical record, every auto license, everything will be embedded on the blockchain for secure access and secure movement.
Right. Even all of the ports now are securing the shipping freight using blockchain, so they know where it came from, they know where it's going to for those purposes. Is that right?
Exactly. FedEx is the single largest user of blockchain technology today. And what they do from picking goods up from a manufacturer and delivering to the end user, and that entire service train is tracked on the blockchain, which includes signing off on receiving the package and instantaneous movement of money back to the supplier. So once everybody signs off, the money is moved instantaneously, securely, and for free. Okay, but the applications can be created by a 14-year-old. There's no barriers to entry, so you're not going to have. Now the difference is the applications have to pay to get access to that blockchain. So whether it's Bitcoin or Ethereum or Cardano or NEM or any of the other blockchains, they have to pay. And this way you get to own internet. So just imagine how rich you are today if you owned email and somebody put a stamp of 1/10,000th of a dollar on a stamp on every email ever sent. It's the calculations are immeasurable. So what we want to do is take a look at really what's happened in the last year on Bitcoin, because Bitcoin really had a breakout year this year. And it starts from many different things of different people, different hedge fund managers coming in here. I should put here Barometer invested in here too, because that clearly was a catalyst for the movement of Bitcoin. But many of the biggest investors in the world invested. And one of the biggest reasons they also invested, and this was rougher, December, it hit an all-time high price of 40,000 US dollars just at Christmas. It's pulled back since January, which is perfectly normal, but we believe it's going higher because more and more people are embracing it and understand it. But the one thing, David, which you talked about before, which scares the living bejesus out of everybody, was what we saw in 60 Minutes, where Neil Kashari says there is an infinite amount of cash at the Federal Reserve, meaning they can print as much money as they want, which means you don't want to own
cash,
fiat currencies. Now, if we take a look at the last 10 years, the best performing asset class in 8 of the last 10 years was Bitcoin. And it was the worst performing asset class for 2 years out of those 10. But after a year of a 5,200% return and after a year of a 1,300% return, Bitcoin has now matured. It is a lot less volatile. It has a lot more buyers and sellers. Its demand is going straight up and its supply curve is horizontal, which always bodes. You don't have to be London School of Economics to know that flat supply and strong demand leads to a higher price. So on that note, David, I thought maybe we would just open it up for questions or answer questions you think your readers.
So yeah, I have a thing I'd love you just to talk a little bit about. My concern has been that every central bank in the world is trying to create some inflation in asset prices to offset the liabilities that they all have, this debt. And as you mentioned, Kashari made the point, we have an unlimited amount of cash, we'll just keep printing it. And so what we're trying to focus on is things that have a limited supply, because if demand goes up and there's a limited supply, then we know prices go higher. So when I talk about looking at commodities, we know there've been no new copper mines built for several years. So that bodes well. We're in a deficit of copper. Probably prices go higher. Companies make a little more money. They pay us a dividend. Freeport-McMoRan, our second biggest position today, reinstated its dividend and bumped it. So that's really attractive. Maybe could you talk a little bit about the limits on supply of Bitcoin? Because I'm not sure everybody understands this, as to how many Bitcoins there will ever be and why there cannot be any more.
So there's really three reasons why people buy Bitcoin in a portfolio such as yours or individually. And number one would be is they understand the technology and they're willing to invest like in any other technology stack that this is going to work. Number two is people understanding the supply and the demand features. And when we talk about supply and demand, right now, the best way for me to talk about scarce assets is gold is always known as a store of wealth and has a scarce asset that grows at 4% per year and has done us well for a hedge against inflation over the last 100 years. So the US dollar is down 99% and gold has protected a lot of people for that inflationary destruction of their cash. Having said that, Bitcoin also today grows at 4% per year. But in the computer program that runs Bitcoin, every 4 years, that supply growth rate drops in half. So today, Bitcoin grows at 4% per year, just like gold grows at 4% per year. But 3 years from now, Bitcoin will grow at 2% per year. And then Bitcoin will grow at 1% per year. So your supply curve is decreasing until it's virtually flat. And if you have strong demand, meaning if there's strong demand for people to put secure transfer of money, if money is going digital, we need to be able to make sure we understand and protect all of that. And that's why people are using Bitcoin as a store of wealth. The others is non-correlated. A lot of people say, why do I put it in? Because as you can see, Bitcoin does not behave like anything else. It is both a risk-on asset, is a technology play, and a risk-off asset. Some of the biggest movements in Bitcoin came when North Korea was firing missiles over the bottom of Japan, when inflation in Argentina hit ridiculous rates, so people in Argentina were buying, when there is a military coup in somewhere like Nigeria, when people are looking for a store of wealth and they don't want the government to steal their money, they're going to Bitcoin.
Right. So all very interesting things. And I would make the comment that while the growth in Bitcoin supply may be slowing, certainly the supply of fiat currency is accelerating. And that is one versus the other. We have a question from one of our clients asking me really how Bitcoin can fit with the Barometer approach. And I think that the answer that I would give just off the hop on that is that as most of the folks on the line know, one of our strategies is a global macro strategy, which is, to be clear, can be in any asset class, long or short, with a goal to own complementary assets. And so whether it's commodities or real estate or currency or emerging markets or domestic markets, Bitcoin would fit in that bucket. And we bought Bitcoin originally last summer, and of course have had a good run with it. But it really started to accelerate when many of the other sort of weak dollar assets started to accelerate, and it's one that we're in. We also have a little bit of Ethereum in the portfolio. So that leads to another question, which one of our clients has asked, and that is, can you just for a second talk about the difference between Bitcoin and Ethereum, and the use cases for Ethereum, because they're quite different.
They are, and Bitcoin was originally created as a peer-to-peer movement of money. And although their Bitcoin blockchain, which is the most powerful secure computer network in the world, the second most powerful secure computer network in the world is Ethereum. And Ethereum was created to provide easy access to embed transactions on a blockchain. So Ethereum, I like to say Bitcoin is the is the movement of secure movement of money. Ethereum is the secure movement of everything else. So if you're going to put Toronto waterfront real estate on a blockchain, meaning where people can buy it instantaneously, buy the real estate, all your legal agreements are all embedded on the blockchain. All you do is send them some Ethereum and you end up with your real estate condo, which is where it's going. And there is a company called Key doing that in Toronto right now. Ethereum is the blockchain of everything else. Okay, there are another 2,000 blockchains that are desperately looking for a use case. But right now, you've got Bitcoin as the granddaddy. You've got Ethereum as copper, meaning the entire infrastructure will grow with Ethereum. But the other emerging blockchains are coming up, but we're still too early for a lot of those for people like you and me, David. Yeah.
So one more thing. I think about the internet as being transformational because it disintermediated so many industries. So, you know, I used to watch my father come home from work, and he had a manufacturing business, and he spent his time talking to distributors, people who knew a whole bunch of clients who could use his product. And so he would sell to these distributors who would warehouse it and sell it out to their customers. And when the internet came along, it sort of disintermediated so many industries and cut out the middleman, right? You were able to ultimately go from the seller to the customer, where we are today. When I look at Bitcoin and Ethereum, I see that again as cutting out the intermediary. You know, we all use banks because we need somebody to stand between us and the other side of a transaction. Or we need a real estate agent to complete a real estate transaction to make sure all the paper gets filed and the money goes into a trust account and finds its way to the other side. But there's a big friction cost. I mean, I've never understood why it's 6% for a real estate transaction. So could you talk a little bit about how this, again, sort of disintermediates and takes friction out of the economy?
Well, that's really the big disruptor, and people have to and it's not going to happen fast. So just because we started talking about this 4 years ago, but I'll give you a few examples. Number one, it disintermediates everything. Lawyers, notaries, but the big one is banks. It does disintermediate the banks. And the example is, and the reason why the Central Bank of Canada won't create a digital Canadian dollar is because their banking system isn't broken. It's expensive, but it's not broken. But for example, stock markets, you will be able to then trade stocks peer-to-peer. If David is selling 1,000 shares of IBM, there's 500 people that are buying shares of IBM, and that transaction gets done instantaneously, securely, you know, at very little cost. And to prove that, we have built at 3iQ with our company, our joint venture partners, MavenNet, QCAD. So we do own Canada's first digital Canadian currency. And we were doing a demonstration between an asset manager and a major Canadian chartered bank where we did a $4 million bond trade. The bond trade settled in T+3 seconds. And that $4 million bond position moved in under 3 seconds, and the $4 million moved in under 3 seconds as well. And the cost of that transaction was 0.2 of a penny.
So think about that in relation to what happened over the past week, where the Robinhood investors all piled into the same stock. Yeah. And from a regulatory perspective, the risk to Robinhood was what happens if these people don't settle their trade? So they had to lodge additional capital with the clearing agent so that the clearing agent was comfortable that there was enough collateral there if the trades failed. And this is one of those things that ultimately long-term, you're going to take some of those risks out of the system. So I don't want to spend too much time on this. I'm just looking one more question. And this is a tricky question I'm asking you because it's hard to explain quickly. Can you just explain why the blockchain helps to secure a transaction? What is the blockchain, and how is that actually securing the transaction?
Yeah, so when we do our webinars, and we are doing one tomorrow, and you can go to our website, thriq.ca, and join up for it. we're not doing the introductory webinar. I've spent 4.5 years going across Canada. And I actually pulled a blockchain up on the internet, and people see how powerful a computer network it is. It's powered by over 40 and protected by over 40 million computers. And really what it is it's a ledger. And that ledger, so if Fred has 1 Bitcoin and David has 1 Bitcoin, and Fred sends 1 Bitcoin to David, there's at least 400,000 computers that are powered by 40 million computers that change that ledger. Whereas if you go to Royal Bank and say, I'd like to withdraw $40,000, and Royal Bank says you don't have $40,000, and you go, yes, I do. It goes, no, you don't. Whereas there's 400,000 computers all over every corner of the world that knows that Fred gave David 1. And Fred now has 0, and David has 2. And you cannot, all 400,000 of those computers have to agree all the time. There's never been a fake transaction put on the Bitcoin blockchain.
So you can't fake it, because if X number of computers all say that it's so, it's so. Exactly. Right. So that's always an interesting concept. Okay. So Fred, I really, really appreciate you coming on. I've got a couple of things just to do to wrap up. You said you have a webinar tomorrow.
We do.
If somebody wanted to go watch that, how would they go watch that?
Go to 3iq.ca. You'll log in for registration. It's at 12 noon tomorrow, and it's going to be fun. It'll challenge people a little bit if they're really looking for an introduction. But David, this has been great. I really appreciate it, and happy to do this again on a group basis again with your clients.
Well, it's very interesting to us, and just so people understand, in everything that we do as a firm, we start with a small position, and if it works, we may add a little bit to it, and we always have a sell strategy and a stop loss. As this has become more and more liquid, it trades more and more like a liquid security, and in fact, from a technical perspective, it's actually been quite orderly. And so I'm going to share my screen just one more time. Fred, can you see this screen?
Yes, I can.
Okay. Yeah. So this is the Bitcoin fund. This is Bitcoin pricing itself. It trends much like other securities do. So we do have a position in our macro portfolio, and between Bitcoin and Ethereum, it's grown to about 10%, which is a sizable position, but that's across both of the two holdings. We've pared some back as it's been growing, because it's been growing rapidly. My guess is, much like this run here that happened in 2017 into 2018, we've probably only just begun, and this is probably a short-term consolidation that we're in here. We'll see. In the other portfolios that we had relatively very small weightings, sort of 2 to 3%. So this is much like an individual stock position or a sector weighting, and it's one that will continue to be managed and monitored, just like anything else. But it's been a very, very good addition to the portfolios. At the end of the day, we make our decisions based on our process. And we're always trying to find sectors and themes and asset classes where breadth is expanding, where more and more securities are participating in a rally. And we've certainly seen that in cryptocurrency over the last year. And that's one that we watch very closely. We also, though, watch for deterioration of breadth. And this is the things that got us out of, energy in 2014 and emerging markets. And it got us out of the bond proxies earlier this year as they really started to underperform. So this is a really important process for us. A week ago, our risk models, the long-term models, were all positive, meaning the percentage of stocks in the US and globally and in Canada that were performing well was expanding. And we mentioned we had some short-term fraying around the edges in one of our short-term indicators. We watched that very closely. We talked about how when the percentage of stocks trading with their 50-day moving average start to weaken, we got to watch it. But realistically, we knew the percentage of stocks above their 150-day or long-term moving average was stable and very rare to have any kind of correction when that's the case. So as we sit today, we had a little weakness over the course of the week in the breadth model globally and a little bit of weakness in the US. Now, in fairness, that came largely last week. At the beginning of this week, the short-term indicator, percent of stocks above the 50-day, reversed back higher. All of the others are strengthening. So our 4 short-term indicators are positive. And we'll see what happens with this longer-term indicator. We reduced a little bit of exposure last week. You know, we tightened up the stops on some of our positions. But frankly, in the last 2 days, some of those leading sectors have gone on to make new relative highs. The S&P dropped briefly out of this channel that it had been in, right back up into it, and very close to highs today. And the NASDAQ is a similar picture. So we continue to be pretty fully invested. As far as the things that happened this week that we want to watch, certainly positive to see all of this improvement in the 7-day averages of cases in COVID. We certainly have had a rollover in the cases in the US. Look at what's happened in India, much more significant. We're seeing this trend sort of around the world. We know that the vaccinations are going up quite rapidly, certainly some countries better than others. You'll notice that on this chart, as a percentage of people who have been vaccinated, Canada's pretty low. It's off the bottom of this chart, but not far off the bottom. About 2.7% of our population has been vaccinated. We know that from a credit perspective, credit spreads widened a little tiny bit last week in investment grade and high yield. At this point, not something to be concerned about. And as far as earnings go, you know, earnings estimates were going higher into the quarterly earnings reporting period, quite different than what tends to happen seasonally. And we know that a very high percentage of companies are beating the estimates. So analysts have been quite cautious. 82% of companies have beat the estimates by an average of 19%, and revenues have beat by an average of 3.5%. Now, one of the things I wanted to show you, I had the guys this morning take a look at all of our positions. We know that roughly half of the companies have reported, and in our US positions, roughly half of the companies have reported. But I want to give shout out to our analysts. Our average company has beaten the revenue line by 5% versus in the S&P 3.5%. Our average earnings surprise is 24.5% versus the earnings surprise for the index at 19%. And the response after the earnings has been in general quite favorable versus the average in the index actually has been sort of a negative response. So I'll give these guys a big shout out because our bottom-up analysts have done a great job in leading us into the right securities. From a sector perspective, our sector weight and technology about the same, financials about the same. We did take our industrials weight down when the models turned down. It's a little more economically sensitive. We bumped up our utilities weight just simply to be a little bit more defensive if we get a bit of a correction. Consumer discretionary has continued to be very important. We took materials down a snip. The year has started really, really well. The equity strategy's up 7-8%. Macro strategies up kind of 13%. Long shorts up kind of 6%. Versus the indices, 1 to 2%. And certainly the income strategy doing very, very well relative to what's going on in the bond market, which is a negative. So all around, I think the sector themes are doing well. We will get defensive if things do get more difficult. I don't expect it to get much more difficult. We said at the end of December, you could see a sort of 3 to 5% pullback. We had up at a 4% pullback last week. So we'll see whether that was it or not. And we're going to watch to see what needs to change. And so I want to thank everybody for joining today. I hope it was useful, a little longer than normal. We'll be putting this up on the web. I want to just make sure people know on our insights page on the website, we are posting all of the videos that we do, all of the various things that we put out over Twitter and the various sort of media spots that we've been doing over the last little while. We want to make sure everyone has as much information as possible. So thank you very much. I appreciate you all taking the time today, and we'll look forward to catching up with you again next week. If there's something to say in the meantime, we'll make sure we communicate. If anybody needs a call or would like to have a conversation, we do think that this shift to a reflationary environment is really important and is not a time to be holding a lot of cash. And so we want to make sure we're fully positioned. Fred, thank you very, very much for joining us today. It's been great to have you on. It's nice to have a different topic, and I'm sure we'll get lots of questions afterwards. So I may be back to you.
Okay, well, thank you, David. And you just give me fair warning before you put me in your short end of your portfolio. Thank you very much, everybody.
Okay, thank you.